Greetings, everybody. It's just gone 12, and this is day 3, I think, of our discounted opportunities series of webinars. Today, I've got Dan and Will from, and let's get this right, Balanced Commercial Property Trust and UK Commercial Property Trust, respectively. So that's Columbia, Threadneedle, and Aberdeen. I think Dan and Will probably know each other, as many people in the property world do. And we were just saying before we joined the main session that it's a shame we didn't organise this for Monday, because obviously one of the big questions anyone will have when they're thinking about discounts is, what are the potential catalysts for discounts to re-rate? And here we are, a day after inflation figures showed a significant fall and share prices of REITs all dramatically jumped. And so we've been through a kind of 18-month, 2-year period when macro factors have been very much against share prices for REITs, and you know, we have early sight of perhaps a reversal in that. But what we're not going to do today is make Dan and Will be macroeconomists. They're both professional fund managers, and whereas direction of interest rates is obviously a very important topic, what's just as important or more important is how both of them can drive returns regardless of what's going on in the macro world. So with that, I'm going to hand over first to Will to talk a little bit about his trust and how he sees things, then to Dan, and then we'll have plenty of time for a discussion at the end, mainly about property matters. Do pose questions in the Q&A. We can get into interest rates a little bit, but we really want to focus on kind of property specifics today. So with that, I'll hand over to Will.
Alan, thank you very much, and a quick thumbs up if you can hear me, which I hope you can. Yes, good, thank you. Hello everyone, good afternoon. My name is Will Fulton. I'm the lead manager of UK Commercial Property REIT, which I'll refer to as UKCM. Now, as Alan said, a really interesting time in the market. I'm going to use this short introduction, 10 or a little bit more minutes, to talk about my views and Aberdeen's view on the market, but also use UKCM to help me do that. So UKCM, I think we're in a great place. We're invested in a lot of the best sectors in the market, and we've got a real potential to drive income, which is one of the mainstays of property and the benefits of property. So that ability of driving income, being in the right place, fantastic place to be. I should also mention, for those of you, we put a lot of photographs in these, but this picture is one of our student schemes at Exeter, and Michael, who works with me, just mentioned that we won an award, a student rated award, which is always good, the sort of player of players award for best student scheme at Exeter. So we're quite pleased with that. But moving on, overview, we're a FTSE 250 company, very liquid, very interesting, and I'm sure all of you listening will know the comparison between closed-ended, both Dan and my funds, closed-ended funds, as opposed to the open-ended world with the risk gating. So the scale of this company and the liquidity it provides is a real benefit. We've also filled it with quality assets and quality tenants, which is great. Really good occupation rates, 96% occupied, 99% rent collection. We've got a long track record, in fact, over all periods we report, of the engine room under the bonnet working really well and outperforming the market, which is encouraging. We've got low gearing, balance sheet control, really important, as you'd expect. So one of those lowest levels of debt at below 17%, 16.5% in the sector, and a low cost of debt as well, which is important. So that's working for us. As Alan said, I've got in here a dividend yield of 6%. That will now be not quite that, given a bit of a re-rating, a little bit in the sector, but also our strategic earnings growth story helping the prospects for future earnings in that. So again, good place. Looking to real estate, Alan asked us, and that's great not to talk about macro, but I thought the one thing that is quite relevant, because there are two elements going on here: what I do and that's what we do to make our portfolios work, which is good, but also the macro impact. And at this period, we're really watching that macro as well. The ability for inflation to come down, for interest rates to come under control, and looking forward to interest rates falling and bringing this sector really massively back into more favor. I think, though, where we are at the moment with the discounts in the sector, it really is an interesting time to look at that, because looking ahead to the potential for growth in the portfolio and growth in rent, but also coming in at a discounted level with a positive future macro story makes it really, I think, really interesting for the sector. And I'm clearly a fan of UKCM and what we've done with it. The story this morning: UK inflation, headline inflation falling to 4.6%. So really encouraging. That should encourage Bank of England, we think, to maintain and not increase their rates. But we're still watching that and then looking for signs of rate cutting later on. In terms of the wider sector as a whole and property valuations, a lot of attention that there was quite a big fall off in values at the end of 2022, but we think we're as a whole sector probably 85% of the way through that, but it's polarized. Some areas, industrial, I'd pick out, faring quite well in this year. In fact, we sold an asset earlier in the year a bit above valuation. Offices are the one to watch, where I think there is more grief to come, more valuation fall, valuers having been perhaps slower to respond to some signals that were around. And then at the bottom there, some annualized returns. This is the Aberdeen House view of property as sector. It's not a forecast for UKCM, this company, but it's a broad view of the sector. And it's quite interesting to see 3 years from September 23, looking forward, an annualized return. It varies from really quite high, almost 9% per annum for 3 years, down to negative 2.5%. And that's broadly living and industrial sectors at the top, and shopping centres and a lot of offices at the lower ends. Skip forward to September 24, thinking about macro picture as well. That range increases to around 10% for the better sectors and 3% for the lower sectors. So we're coming into quite an interesting environment, providing portfolios are positioned in the right way. Now, on positioning, I suspect that many of you won't be able to read the detail of this slide, but let me try and summarize it. We're looking at the 4 broad sectors: industrial and logistics, retail, offices, and student housing and living. I'll tell you in a minute how UKCM is invested. But the industrial and logistics, the great market, fantastic tenant demand. And as with everything, one has to be invested in the right place. But with that, really, really strong demand. Supply or availability is sitting at around 4% at the moment, which is a really low number. It's quite expensive to build new sheds, difficult to get planning permission in the right space. So there's a supply constraint meeting great demand. And that demand is continuing to come from e-tailing. So perhaps fallen off a little bit recently, but still growing, growth market, buying online. And we see, for instance, Marks and Spencers are in the market at the moment for a large warehouse to boost their provision. So not picking them out specifically, but the idea that if you want to go and order a pair of shoes or a t-shirt in size medium or size 10, it's not going to be in stock. And so companies are looking at onshoring and having more stock in the UK to get to market faster. So this onshoring and e-tailing themes are playing out. And we think this is going to be a multi-decade experience, not a flash in the pan. So that's there to stay and growing. On retail, an older story here. I remain very wary of shopping centres and fashion in the high street by and large. And I favour what I describe as discounted retail parks, places that are in really good spots where people can travel to, park for free, low rents, importantly for the tenants, so tenants can make a profit. We have a scheme, Trafford Retail Park, opposite the Trafford Centre on the motorway. It acts both as a sort of fast food outlet for people using it as a service station for the motorway with 4 food outlets, but also almost a semi-suburban shopping centre, but with free parking, low rents, multitude of tenants in there, and actually more demand than we have space for from those tenants. So that kind of thing, low rents, tenants make a profit, good. Offices, I'm sure again many of you have heard of this. I really worry about the office sector as a whole. There's a small slice of that office sector that in the very best buildings and best spaces that is getting quite good rents. But the vast majority of offices, I think, have got more trouble to come, more valuation trouble. And I'm seeing that in 2 areas. First, from businesses looking to naturally cut their occupation costs. So let's say a business wants to reduce their costs by 30%. They will then take that reduced budget and focus it on a smaller but better quality building, be prepared to pay more rent for a better building, but less rent, less space. And that's happening across the country. So there's a real polarization of demand. It's being led by COVID reinforcing agile working, people not requiring or wanting to come to work 5 days a week and sit at a desk, but also by regulatory environmental standards from the government, energy ratings. So as I guess you all know, like buying a fridge and you get an A, B, C, D, E, F energy rating, you do on property assets as well. And there's a requirement, an expected requirement, to be a minimum C energy rating by 2027. Most of the offices around the country will struggle to meet that. And if they are to meet it, it's going to require a lot of new capital expenditure, which I don't think will be rewarded by rent. So worried about offices. Student housing and living, a bright spot, again, especially in the right space. Student schemes we've picked are in low supply, good university towns, and that remains a growth market, as does parts of the living market. So using that and thinking about that and where UKCM stands, just 2 very quick points to make on this slide. The 4 bars are grouped by, on the left, industrial, then alternatives, then offices, and then retail. And the colours show different time periods. So let's say navy blue industrial, UKCM held shortly after we took on as Aberdeen management of UKCM, 34% industrial. That was up to 58% in December 20. So a movement into industrial. And we did that. I took an active decision to sell retail early on. So on the right-hand side of the chart, you can see 37% retail, sold down to 14% retail. So that's early action. And that's part of that is using the strength and depth of Aberdeen as a manager. We've got a very well-respected property research team. So from a property macro view, there's really interesting guidance there. And then I, with my dedicated team, can go in and choose the assets that we want. Freedom in that respect, reporting into the board, but we took that early decision, helped by research, selling out of retail and building up the industrial. We were able to get into really good spots, and that's reaping rewards for us now. Moving on, just to bring some of these to life, the kind of property we own, I think the thing for me which is important here is the quality of the assets and also the quality of the tenants in that. Thinking about you as an investor, potential shareholder, the strength of your income, the ability to keep that rent collection and occupancy. So going around clockwise, Radlett, our largest asset, North M25, earlier in the year in Q1, we saw 60% growth in rent over 2 years. Phenomenal growth in rent, capturing reversion. So that's the, as again you'll know, reversion being the market rent versus an older rent, and huge positive reversion in many of these industrial properties. So we had a couple of companies coming in. One was a distributor of aircraft parts around the world, and the other was in film and media. They create studios for people to use. So quite diverse mix of tenants coming in there. To the right-hand side, an asset in Leamington Spa. This is a warehouse. And again, if anyone's looking smartly, the shading on the roof is not sort of roof repairs. That's actually solar panels. So again, from an environmental perspective, these huge football-sized multi-football pitch roofs are brilliant to put solar panels on and supply better cost electricity to our tenants, environmentally friendly. Bottom right, Malden Hotel in Newcastle, quite relevant because we're in the process of building a hotel in Leeds at the moment, actually, which is going to yield 7.25% on our costs when it opens in August next year. But this is a completed hotel we funded, run by Delata, and it's absolutely brilliant. This hotel completely paid all their rent through COVID. The manageress here is amazing. She runs a really tight ship, and in this particular hotel, they split the top floors. They have a contract with an airline, so it's a very quiet, peaceful space. I suspect there might be a little bit of a buffer zone, and then they have revelers coming in on the bottom floors. So they're using that Newcastle market really, really well. Really good occupancy. It just does very, very well. And I think Leeds will be the same. Moving on to retail parks, one example of our discount retail parks, this one on Junction 27, the M62 at Leeds, phenomenal population conurbation here, an IKEA anchor, which we don't own, but everyone coming in to eat meatballs, look at furniture, comparison shop. It's just a really busy, successful retail park, fully occupied. And then on the left-hand side, one of our offices, this is an example of a good office. When we bought this, it had a £16 million refurbishment, and the developer had put in electric electric air conditioning and heating. And that's one of the keys in the office sector, switching away from gas into electricity for environmental reasons. So we already have this, again, a really popular building. But as an exposure, we have very, very low, 13% exposure to offices. So again, not a fan of offices, but a select number work. Nearly finished and moving on. You remember at the start that I mentioned really the ability of property to deliver rent, and importantly for me, positioning UKCM's portfolio so that shareholders can benefit from earnings growth and the opportunity for our dividend to grow. Quite a lot of moving parts on this graph, but it works very simply. It looks at our rent in June, £67 million on the left-hand side in dark blue, moving to the potential to grow that by almost 30%, 29% within the portfolio to £87 million. That's a theoretical, so the health warning, that's a theoretical position. Everything 100% rent, let, we're only 96% at the moment. That's a really strong figure, and everything at this rental value. But if I interrogate this, just 2 points I draw out. We're asked quite often by shareholders, well, how quickly can I get my hands on this extra rent that you think you can deliver? And we're very confident in that with the dedicated team we have. So there are two strands. The first is the turquoise 4.8 million. That will come on stream from the completion of our Hyatt Hotel in Leeds, which we're going to operate, deliver a 7.25% yield and cost from around August next year. So that's very short term from that popular living space. The other slug of income, 11.6 million, is in the field called reversion. This ability to capture the rent. A lot of our properties are almost pregnant with rental growth. It's actually catching today's rent and converting that rental value into cash. £12 million there, and around about 80% of that is available within 4 years, and about 80% of it again from industrial. So high confidence on those two strands of the income. I think my second last slide here, as I'm back with you. close very quickly. ESG, really important for everything we do. 3 examples here. I've talked about Exeter, our retail park at Trafford. Interestingly, we used almost 2,000 tyres within the bitumen to resurface the car park. It's the reason there aren't any cars in. It was just resurfaced. It's one of the busiest in the country. And our hotel at Leeds, where we've put in an electric heating system. Again, that's part of what the development team that I've got access to in Aberdeen add to this process with our team. Brilliant. And moving on, an ultimate slide, the investment case. I'm not going to go through all of this as Alan looks at me, but I would say I think of UKCM as a one-stop shop for people's property needs. We've got to focus on building our income, which you'd expect and want to see in the potential for dividend there. I think we've demonstrated that we've got agility in allocating away from retail into industrial. We can move, use our research, the amount of people we have on the ground as Aberdeen in the sector, looking at deals. We can move across sectors. Very robust balance sheet. The board very focused on that. Selling £74 million of industrial earlier in the year at 3.5%, repaying some of our revolving debt. Active portfolio management, everything we live and breathe for, love doing, and it's working very well. Diversified tenant base and outperformance. So a really good story from that perspective. Alan, that's me. Thank you very much for your patience.
Thanks, Will. And there'll be plenty of time at the end to get into some of those topics in a bit more detail. But before we do that, I'm gonna hand over to Dan, who's got quite an interesting heading for his presentation. So let's have a look at the contents. Thanks, Dan.
Afternoon, everyone. My name's Dan Walsgrove. I'm the Deputy Fund Manager on Balanced Commercial Property Trust. I'll refer to that as BCPT through the presentation. Now, I was going to look more at kind of navigating the current environment, both at the sort of macro and the real estate level. But to start with a quick introduction to BCPT. Now, there's a lot of information here that you will want to read in your own time, but effectively we're a real estate investment trust and we're offering balanced exposure to the sector. So we're diversified across industrial, retail, offices and alternatives. We've got a portfolio of 35 assets with a portfolio valuation of just over 1 billion. Our investment philosophy has always been focused on core plus real estate in resilient locations. So what I mean by that is effectively high quality buildings with a low to medium risk profile, but with the potential for value add through asset management. In the bottom right, you'll see the portfolio performance. It's been the benchmark over most time series. This is the MSCI benchmark and delivered annualized outperformance of about 130 basis points since inception. At the corporate level, it's a FTSE 250 company, market cap about 470. So again, it's a sizable and liquid vehicle. Slightly unusually, we pay a monthly dividend. We've just increased that by 10%, and that's yielding somewhere between 7.5% and 8% fully covered. We're lowly geared at 24% with a low cost of debt, about 3.3. We've just restructured our principal debt because that's due to mature in 2024, but I can touch on that again shortly. Talking about kind of discounted opportunities, we're currently trading off a discount, I think last time I checked, about 41%. That is wider than the peer group, which sits in the kind of mid-high 20s. That feels very wide to me, given the growth potential that we do have in the portfolio. For instance, we've got 16% income reversion day one to be gotten at through asset management. But I'm sure a number of managers have sat in front of you and said something broadly similar. Sat behind our discount specifically, I think there are 2 specific drivers for us. Firstly, we do carry a marginal overweight to the office sector, where sentiment has been weak. We're holding about 30% of the portfolio against an index at 24. And secondly, our debt matures in 2024. Now, thankfully, these are both things that we're able to actively address. So here are a couple of our kind of key strategic objectives at the minute. I mentioned we've restructured our debt. What we've done is effectively secure optionality for financing beyond 2024 without committing to a rate at this point. So we do have that optionality going forwards. And at the same time, we're looking at a capital allocation strategy, down weighting our office exposure and holding the proceeds on the balance sheet again to give us optionality around potential leveraging rates going forwards. A couple of the other things on here, we're working very hard to boost our portfolio income. As I mentioned, there's a 16% reversion there, and we can get that through asset management. And that's what really underpinned the recent uplift to the dividend in September. We're also looking at furthering our ESG agenda. I mean, ESG is now a given for the real estate investment trusts. We've just had our 2023 GRESB rating, which is the Global Real Estate Sustainability Benchmark, come back at the top of the peer group, which is fantastic news. And we're looking for incremental improvements on a kind of year-on-year basis going forwards. So moving on, I thought I'd start with a kind of bit of a snapshot of where we are in the market cycle. First chart here shows we've seen a kind of swift repricing of real estate following the mini budget. And on the second chart, you can see the discounts blew out in the diversified space at the same time, almost the levels that we saw during the COVID pandemic. Since then, there's been a notable stabilization in capital values. So that suggests we are approaching the next kind of market cycle, next stage in the market cycle. And as an indicator of where that takes us from here, I've just put a table that shows the returns that have been delivered at the all property level in the wake of previous price corrections. Now, it makes for fairly compelling reading. Obviously, this is in the past, but looking back to the time of the GFC, for instance, you saw annualized returns of about 11.5% in the 5 years following the GFC. Now, we've not seen as much of a correction this time around, and discounts, if you look at them as a forward pricing mechanism, don't necessarily suggest that the market's going to behave in the way that it has done in previous cycles. I suspect a large part of that is linked to inflation. So the post-GFC recovery, as you can see here, was supported by loose monetary policy, whereas this time we're looking effectively at a higher for longer scenario. This is weighing on real estate, but in reality, this is just another market cycle. And over the long run, real estate generates, or it has generated, 8.2% annualized. And it's actually that period of ultra low rates that's been the kind of historic anomaly. Now rates are held. We've had some good news on inflation this morning. So hopefully the worst of the kind of inflation-led uncertainty is behind us. And as we look forward, markets are still pricing in elevated rates for a long period of time. But in previous cycles, markets have actually overshot this and thought rates would stay higher than they did. And so you've got some economists now looking at potentially quicker falls. But regardless of the pace of those falls, the next movement is in all likelihood going to be down. And as rates do begin to fall, which is the expectation for kind of the middle of next year, it's going to be a very interesting point in the cycle for real estate. But until we get to that point, we are really looking at income-led returns rather than capital-led returns. So over the 12 months to June last year, capital made up 75% of the total return, and that was essentially facilitated by that free money. But in the long run, that figure should actually be 20-25%. And that, again, it's just what real estate should be doing. And that's what we're doing at the minute. This market cycle has been very kind of firmly about thematic, sector-specific investment. But going forwards, I'm not sure that's going to be quite enough. Obviously, sector allocation is very important for all the reasons that Will's already run through. But outperformance is going to be a lot more nuanced when it's delivered through income rather than relying on capital to get you that. So firstly, just starting on sector allocation, there's been some major divergence in recent years between the sectors, predominantly because of structural shifts that we've seen, kind of major shifts like e-commerce being accelerated by the pandemic. You had hybrid working becoming entrenched. You've got an aging population. You've got the younger demographic turning to higher education in challenging economic times. And I've put up here a table of kind of our house views of sector dynamics and the relative winners that there are going to be within them. We're really looking at those sectors and subsectors where you've got a stable income return with the potential for rental growth, and that's coming from a supply and demand imbalance. Rental growth, in turn, is what then drives capital markets and yield compression. So those sectors that are seeing the rental growth, we expect they'll lead the market recovery. So where we're focusing for BCPT is firstly on industrials. We're 30% industrials, and we look at kind of key industrial arterial routes where you've still got that constrained supply and development. We're about 10% alternatives and would like to upweight there. So we're targeting student housing where, again, you've got a kind of structural undersupply and a very good domestic and international demand base. Retail warehousing, that gives you an attractive income return and a yield premium over your industrials or your alternatives. and that's sustainable because you've got low costs and you've got a very strong tenant base there. So we've got two large parks in Solihull and Newbury, and they're both fully occupied, and they've both been two of our best performers over the last 12 months. We are looking to downweight our office exposure, as I mentioned. That's going to be selective. I mean, selectively looking at disposals of some assets, effectively where we've delivered the business plan. And we're also looking at repurposing some offices to alternative uses where you can create value, and I'm sure that's something we'll come to discuss later. I guess the main message here is it's not really enough to be diversified or just to look at things at a thematic level, because there are nuances within these submarkets. So if you take industrials, for instance, we've seen stellar rental growth, really strong yield compression, and that was almost indiscriminate across the sector for a period. There's still rental growth coming through. It has moderated a little bit, and behind that you've got slightly more discerning tenants because of the nature of the economic background. You've got some of the big e-commerce occupiers retrenching a little bit, and you've got tenants generally looking for higher quality ESG compliant buildings. So merely allocating to the sector could leave you catching a bit of a cold if you're not in the right parts of it. So you've got to be forensic on your sub-markets, but also your assets, so that you can actually capture the growth that's coming through. So locations of constrained supply in industrials would be like Greater London, for instance, and they'll generate the greatest rental growth, so they will outperform the wider sector. But you've then got to have the right building to actually be able to capture that growth through managing the tenant that you've got in there. So alongside sector allocation, you've really got to look at effectively stock selection. Across the real estate market at the moment, it seems a bit of a secret that the occupational markets are actually in very good health. We're at the headline level seeing rental growth across all the sectors, and that's really important at a time when income is generating your returns. But it's asset fundamentals, like the other things I've put out here, so functional relevance of the building, and by that I mean the role it plays within an occupier's operation, how central it is to them, the quality and flexibility of the accommodation you've got, the long-term value attached to the land. All of those things dictate your ability to execute asset management initiatives, be it leasing, refurbishment, or redevelopment. And that's how you crystallize growth into actual performance. And I've set out a couple of examples here. As I mentioned earlier, we've got an income reversion, and asset management is key in kind of unlocking this. So a couple of examples: we've got a city office holding, Birchin Lane, where we've carried out cyclical refurbishment. We're seeing that back in the rents, getting a 20% premium on where we were before. We've got a retail unit on Oxford Street, where you've got improving market dynamics, and so we've been able to more than double the rent at the lease expiry there. And we've redeveloped two older industrial units down in Southampton and moved the passing rents on substantially there. So this not only boosts your income, but you'll also be rewarded with kind of better capitalization rates, so it helps you capital growth. And in an environment where you're not necessarily going to be trading a lot of buildings, the ability to add value is enormously important, but it's asset specific and it's sector agnostic. So stock selection is going to be a crucial part of returns going forwards. The last thing I was just going to touch on was balance sheet resilience. Obviously, this has taken up a lot of headlines recently, and it's not necessarily the availability of debt that is problematic at the minute. It is readily available outside of kind of the weaker office markets and perhaps some development, but the issue is that it's not available at levels that are currently accretive. But to my point earlier about what you can expect from the market going forwards in terms of returns from the next phase, I've put some forecasts. These aren't our house forecasts, these are from an agency, to give you a bit of a flavour of the expectation. But where we are now is that pricing's adjusted to a point where real estate is yielding pretty well against long-term interest rates, say 3-4%. And once we reach that point again, that's when you're going to see capital growth coming through and debt becoming accretive again. But for now, you've really got to mitigate your risk against your debt profiles. You've got to pay down debt where it's appropriate, managing your maturity profiles, mitigating any increasing finance costs. You can do that through selective strategic sales. You can do it through delivering rental growth through asset management. So there's a number of ways you can manage this risk, but locking into long-term rates at the minute would be detrimental to earnings. But I guess an important message is that across the REIT market, its leverage is low. I think it's low 30% across the real estate investment trust. So it's a manageable level of exposure. And as I said, we're probably actually one of the more exposed with a maturity next year, but we've got the option going forwards. We're only 24% levered, and we've got the option to look at some sales to pay down some of that debt. So feel in a fairly good position in relation to that. I've put a couple of takeaways to read in your own time at the end, but yeah, that brings me to the end of my presentation.
Thanks, Dan. That's great. I used to walk past that Birching Lane office every day for about 10 years. Not that means I know anything about it, but it's nice to see.
It's in the right place though, doesn't it?
Familiar buildings, yeah. So thanks both. I think one of the best recommendations I could make for any investor in investment trusts is, obviously there's a wealth of information out there from people like Kepler, but there's also this amazing document called a report and accounts, and anyone investing in investment trusts should have a look at it. But one of the things about property trusts is, of course, they control the assets. They're not fractional owners of equities, and so the information in the report and accounts is very, very specific and detailed. And with that does come quite a bit of jargon. So I'd kind of thought the first topic to talk about was headlined as "Let's talk about reversion." You both mentioned it, and I know there are people on this presentation who probably do know what reversion is, but it would be helpful, I think, just to kind of set out what it means and how you can pull levers to make it to release that potential. Where does it come from? It comes from voids, it comes from properties being under rented, and I'm using jargon to describe it now, and so it'd be interesting to hear from you how you can release it. But I think more generally it'd be interesting to hear from both of you how you might, if you were given each other's report and accounts, what are the 2 or 3 things that you'd be looking for to assess the potential? Reversion is obviously one of them, but what else do you look for? So, Will, if I may, just to give Dan a break, do you want to take on the what is reversion anyway bit, and then we can kind of get into how you release it?
Thanks, Alan, and I'm sure Dan would say the same thing. I actually think so. There are 2 things that are important about reversion. Reversion is if one of our industrial tenants, the example I used in London, was a tenant who had been paying £12.50 per square foot for their industrial unit. They left, and very, very quickly, in a matter of months, we filled that space with someone else who was paying £17.50 per square foot. So the difference between the £12.50 and the £17.50 was the reversion. In any portfolio you look at, there will be a mix of reversion, which is the ability, it's the theoretical value of today's rent in a portfolio versus the passing rent. And the passing rent, the rents tenants are paying, is a mix of some tenants, perhaps if people are in shopping centres, some offices, the rent would be higher than the rent you could get today. And as a generalization, taking Dan's point, doesn't apply everywhere. You've got to be in the right spot. But industrials tend to be the other way. There's a lot of inbuilt reversion in that portfolio. Today, if a tenant left, you should be able to get a higher rent straight away. That is different from rental growth, which is the future expectation for rents to grow. And again, back to the industrial sector, and we've both got decent exposures, UKCM, a bit higher at almost 60%. But with that exposure, rental growth prospects in the right sectors are again stronger. But that is different from the reversion, which is the inbuilt ability to convert it. And Dan might be talking about asset management, but we both do that. The examples of the media firm that I talked about, or we have another example of a linoleum manufacturer who we knew they were paying a big rent in very central London, and they wanted to reduce that rent change their business from actually, in this case, supplying office kitchens with lino to schools and hospitals with lino. So it suited them to be on the N25 rather than central London. They doubled the rent to come to us, which was still good value and still below some of the rents they could find. But for them, it was great value because they were halving their rent, doubling our rent. It's great. Second question, Dan, you asked is well, probably lots of questions that people would ask about reports and accounts, but just I think the three that I think are interesting, I suppose, is that ability. How much reversion? What is the potential to grow earnings? And so what that might mean for dividend cover and dividend. That's one thing. That then is influenced by the allocation to sectors. It's not all about sectors, and Dan made the point. I agree that one has to own the right kind of asset, but in the right space. But having it in the right sector is a massive tailwind to help propel capital value and earnings. So allocation in there. Not a fan of huge proportions of offices. Let's put it politely. And it has to be said, debt. And I really interesting this thing, Dan, but and I agree. We've got a very low level of debt and very cheap cost of debt, but looking at maturity profiles of that debt and what one might do in a probably a higher interest rate environment. I agree, very easy, we can go out and get debt, but it's the cost of debt which matters. So again, in UKCM's case, 80% of our debt is at a cost of 2.9%. So low controlled balance sheet management. There's three things.
I think the thing I'd add to that as well is from the pros. Effectively, it's the intention of the manager and the board in terms of where they want to move that portfolio, because dynamics do move very quickly in certain sectors, and so you've got to be able to align your portfolio into the right segments of the market, and that's exactly what UKCM have done. I mean, you put the graph up earlier to show early movement into those sectors, and that's very, very important.
Yeah, and I guess it's just worth adding, at least in part, the numbers you'll see in accounts estimating your reversionary yield come from third-party independent estimates, don't they? Savills or whoever it might be will say, the local rent for this type of building is X, and the difference between the two is not decided by you; it's decided by someone else, isn't it?
You're absolutely right. We've both got independent external valuers who put their own view on. It's not our view, and you probably see in various announcements that people make when they, it's great. We've got a 60% increase in rent, but also we're looking to outperform that rental value. So we've got instances of rents being set ahead of the valuer's ERV and therefore, rental value. And so that goes to NAV. It's improving the NAV. So I'd say there's sort of upside risk, if you like, in those industrial rentals that are probably in some valuations, and certainly we've experienced that with some of ours, as opposed to some other centres. Let's say again back to shopping centres or poor quality offices where there's probably downside risk in that rental value and renewal. So again, good to have the industrials.
Yeah,
it's also a question of how quickly you can actually access those reversions, because obviously leases are fixed. Generally, you get 5-year lease expiries or rent reviews, and very long-term income is obviously very beneficial from a duration perspective. It doesn't necessarily give you the opportunity to get in and add value. So the shorter term income can be extremely valuable if you've got income growth coming through. So on our industrial portfolio, for instance, you've got an average kind of weighted unexpired term to rent review of about 3 years. So that's the sort of time, if you're looking at modelling earnings going forwards, you want those industrial those events in the industrial leases to come forward so that you can address them, you can unlock that market growth, because otherwise it sits there until you have an opportunity.
Yeah, that's an interesting point. And as managers, there was this. Dan, you mentioned the end of free money, and in that era, long leases with lots of leverage was a thing, wasn't it? It was a strong preference, and do you have the sense now that there's a shift in preference because shorter leases come with a different set of risks, but they also come with a different set of opportunities? Is there a real shift in preference in your groups for that?
Not entirely. I think you have to have a bit of a balance, because I've already talked about the benefits of the shorter income, particularly in the growth sectors. But when you look at the longer income, what you tend to see with those sorts of leases is indexation. So you've got some sort of inflation hedging in there. It might not be full, but it might be partial. But it's doing what real estate should do in offering you that inflation hedge effectively. So you'll tend to have, as an example, we've got a student housing block down in Winchester, which is long let to the university, and that's got annual inflation linked rent reviews in it. So that helps you just generate some of that rental growth coming through, and that would be on top of any day one reversion you've got. To Will's point, you've got the day one reversion, but then you've got rental growth on top of that coming through, and so those longer term leases certainly have a role to play.
Yeah, well, it's interesting. I don't know if Dan agrees, but I like, to the point on shorter leases and some of those industrials, it's good because of the accessibility to that reversion faster, and often with index linked leases, it's very common to have a cap and a collar, so that there would be a control mechanism for a tenant not to pay more than 2% per annum or 4% per annum in their leases. So actually, go back a few years, inflation very low, and that was kept track. Now, actually having access to an open market rent to be able to, it is almost a better track of inflation, and in fact exceeding inflation. And that again depends on interrogation of the sectors and the assets. So probably having a little bit of a balance of both is quite interesting, but just having, a portfolio full of capped index linked leases because they're capped is probably not great. And then actually, if they're not capped, unless the tenant is absolutely lock solid grade A, that's going to put a huge extra burden in this environment on the tenant to pay that. So there's an interesting balance. I quite like the shorter term and industrial to be able to get that. Again, in the office sector, I'd prefer not to have short leases if I were invested in that, because it probably goes the other way. So it's about agility for allocations, Dan said earlier.
Yeah.
Just to that point quickly, I mean, we do have some. So if I look at some of our central London office holdings, and we do have some of those shorter leases coming through intentionally, because actually in some of these cases you can step in, as I put in the presentation, those lease events not only give you a chance to gain market rent, but you can also then step in, refurbish buildings, and if they're the right buildings in the right places, then you've got rental growth coming through. I mean, if we look at West End, you've got rents now prime rents ahead of where they were pre-COVID, and so you can move in and you can effectively gain those rents by carrying out refurbishments, and lease expiries and events give you the opportunity to do that as well.
Just turning to, you both mentioned industrials as a favoured sector, and I guess if investors are coming to real estate anew for the first time in a while, this is a big part of the economy now, but it's perhaps a little bit misunderstood what it actually is. It's quite a big catch-all, isn't it? And there's no doubt that it's been well covered that this is a good performing sector in the last year. But for neither of you, this isn't a new development for your portfolios, is it? It's been a long time coming, and Will, you touched on the timing of your strategic change. So do you just want to talk a little bit about the backdrop to why that sector has performed so well, and who are the tenants? What are the buildings used for? Dan, you mentioned, I think it was Dan that mentioned solar panels on the roofs. That's one aspect, but and perhaps you could touch a little bit on the ESG aspects of those assets. But how did this sector become so prominent? And why do you think it will? You know, it's been coming for a long time, hasn't it? Why do you think it will carry on performing well?
I'm going to say I've got a slight advantage over Dan because I suspect, I probably know I'm a bit older, but I liken it if one.
Again, Dan's young enough to understand the internet economy, isn't he? So
I know.
maybe
So
he's got an
brilliant.
insight over you.
Absolutely perfect. But going back to the late 80s and early 90s, when retail warehouse parks came along, one of the drivers for that was a planning relaxation around cities where, shopping was driven out of, a lot of regional cities into retail parks. And so the driver was a planning relaxation, everything being built and people enjoying the freedom, whatever, of free parking, all of that. From a fashion perspective, that has sort of gone wrong. It still works for low rents and discount retailers who use it as a bit of a click and collect service. But for the fashion, it went wrong. But it lasted 20 years or so of a really interesting market. In industrial and logistics distribution, the driver for the change, I feel, is twofold, starting with e-tailing. So technology, people across all sectors, people looking at equities, what technological changes are going to positively or negatively impact my stock? And here, technology, the internet, has dramatically changed the way people shop. And that's sort of an old story. It's dramatically boosted demand for warehouses. There weren't enough in the country. People tried to respond, developers tried to respond, but there simply wasn't enough of the stuff around or built. COVID then exaggerated that, and it's very difficult to buy physical goods. That's come back a little bit, but the habit and the ease of online shopping is here to stay, and that will continue to increase, and the UK is at the forefront of that. Add to that world troubles and businesses' desire to have onshoring, so to have more stock in the UK, potentially more manufacture in the UK, rather than risk a 2-day supply chain from China or canals going wrong or all sorts of things. The idea of people wanting to have more goods in the UK, which they need to store in warehouses, has sort of accentuated that. So those two things, and Dan said as well, low supply in the market, add to that being in the right locations, motorways around urban areas, then I feel it's got it's a decade-long experience we're going to have. It's a structural change rather than just a flash in the pan. This is going up. And the final thing I'd say, the catch-up in rents is really, again, particularly around urban centres, is really significant. From then, though, it doesn't stop, but it will be more gradual, I feel, going on from there, but it will be positive. So that's my take on that. Really, really interesting from those two sides.
Thanks, Will. What's your take on it, Dan?
Well, I mean, Will's covered it fairly comprehensively there. I think the thing I'd add is that there's a really good depth of demand. As Will says, you've got, the big drivers have been e-commerce in recent years. Going back to the pandemic, they were, I think, 60% of take up. They've fallen back a bit, but they're still very much there. But you've got a really good breadth of demand. So you've got the onshoring of manufacturing. You've got, in fact, some effectively traditional retailing. We'll be taking industrial for distribution hubs, and that's a large part of the market. But yeah, we've still got a very good exposure to manufacturing. But you can have those kind of softer uses, effectively sort of your builders, merchants, that sort of thing. So there's a really wide scope for tenants there. We're letting units at the moment to occupiers that I wouldn't have dreamt of, if I'm honest with you. But there's just such a breadth of demand for the right kit. But I think increasingly it does have to be, to your point earlier, Alan, it is increasingly focusing on good quality stock. So occupiers are increasingly looking at EPC ratings. Are there good solar panel systems on the roof that they can cover and hedge their energy costs against, that sort of thing. And we do have a pretty constrained supply pipeline still, and I think that's really going to help support it going forwards, because you've got that constrained supply at a time when everyone wants better quality stock. So that's really going to keep the demand strong, that in the market, and And it's when you get the better quality prime kit coming through, that's when you can push rental growth on as well, and then that trickles down. So I think the fundamentals for the sector are still very strong at the kind of headline level.
I think we started.
Yeah.
I think we started a couple of minutes late, and I can see our attendees number is holding firm. So we might just explore a little bit offices where certainly in terms of percentages, that's the, I guess that's the key difference between the two of you. So Dan, property is one of those things where everyone has an opinion because everyone uses property, but amateur opinions may not necessarily be right. So you have a decent exposure to offices, and we probably don't need to rehearse all the here's why offices are a thing of the past. There's people are still in offices. You're both in offices, and there's still a need for them. How do you see the sector developing? Do you see that there is some supply coming out now with change of use, and that pricing is compensating you for what must be, as an asset, as a sector, higher risk than it perhaps was 10 years ago?
Yeah, I think there's two major issues behind the sector at the moment. I think the first, obviously, is working from home. That was the big driver in the change to the sector. I think where we are now, though, we're more or less stable on that. I mean, three days a week has become the norm. I mean, that wasn't necessarily abnormal pre-COVID, to be honest with you. I mean, we had I think occupancy in the West End pre-COVID was about 70%, and we're in the low 60% now. So we're kind of there or thereabouts. But it is very asset specific, and the other thing that is being closely looked at is ESG. So there's a good level of concern around secondary buildings in particular, in terms of keeping them compliant and keeping them to the standard that occupiers want. So there are certainly some secondary or even tertiary segments of the market which you've got to be worried about. There's that capex risk, but there's also kind of occupational risk in the long term. But there are segments of the market that are holding up, and it's all about your ability to effectively make accretive investment into your buildings. And if you've got buildings in the right locations, effectively core city centre, good quality, that's in very tight supply. So again, looking at the West End, where we've got a bit of exposure, you've got vacancy rates below 5%, and it'll be even lower in the prime parts of the market. So as long as you can make investment into your buildings, and we for instance have recently surrendered a lease in a Mayfair holding, refurbished it, and now we're reletting it kind of a good premium above where we even expected that to go. So there are parts of the market that are holding up. I think the other interesting thing to your point is that there is now stock coming out of the market. So planners are now more supportive of alternative uses. So you're seeing, particularly in the southeast, a lot of assets being repurposed, either for residential or for wider alternative uses, industrial schemes, that sort of thing. We've got a major HQ building out in Stockley Park, which is one where we're looking at what will be quite an accretive alternative use play. So it's not a case of every office have to go. It's very asset specific in terms of where you think there's value to come from, and some buildings certainly have that. Some, however, are really going to struggle.
Yeah. Do you have anything to add, Will? Just being mindful that time is the sands of time have.
Just very briefly, because I agree with Dan. I did read about I think the potential office conversion. I think it's a really interesting idea, and I suppose one of the other things. So I'm not, as you probably tell, a fan of offices. I think it can be difficult to make money just at the moment. But the other thing that we've probably, I guess both have got is I've got a dedicated team working on UKCM. I've also got behind that a huge Aberdeen real estate team, and all my colleagues are out in the market. So it's quite interesting to be able to get where is working, what is working. If some of my colleagues have some more offices? Are they putting flex space in? So that strength and depth in the market is quite useful as a way to drive it. And I'm sure Dan benefited that on his, it's not conversion potential, that's probably the wrong way of putting it, but the ability to look at alternative uses for offices, which is where a lot will go. That's a good one to do. There are a lot of offices that won't be capable of being converted or will not be in the right kind of market for various schemes. So it's difficult at the moment. Living and the student market, alternatives in industrial, discount retail is where I prefer. But they're a very small fraction of the offices which I think will, yeah.
Thanks both. And I expect you're both relieved that we didn't have to spend very much time on interest rates. But if I could just wrap up by saying, it is, green shoots and all that. It's one, and one swallow doesn't make a summer, but good numbers this week on inflation are very positive for property potentially. The share prices of both these trusts and all their competitors have been driven by macro factors. But what you've heard today is that tenant demand in some sectors is very strong, and so there hasn't been huge issues with voids, and yes, companies go bust, but it's kind of business as usual in terms of property management is the message that I'm getting from both of you. And notwithstanding quite substantial share price rises yesterday and today, both trusts still on big discounts. Dan in particular, as you say, over 40% after the price rise. So definitely worth everyone on this call getting those report accounts out and having a further dive. So with that, I'll thank both of you. Thank everyone who's still on the presentation, and we'll see you on the next one.
Thanks, Alan. Thanks everyone for listening.